There's word tonight of a bailout package for British banks. The BBC is reporting the government is poised to put about $100 billion into stabilizing the financial system. British banking stocks have taken a big hit in the markets. Here in Canada, the latest casualties of the financial crisis could be anyone looking for a mortgage. Today, one Canadian bank raised the rates on certain kinds of loans. Chris Brown reports.
The view from Mahmet Bagriaksik's condo isn't quite as sweet as before his bank told him no, he could not borrow against his equity to make other investments.
The lady who works at the bank, and then she came up with reasons, and she started to talk about the economies and how it's going really bad.
Going bad, as in it's harder to get credit, and the cost of borrowing that money is going up too.
And over the last 3 weeks, we've seen variable rate mortgages go from pricing at 3.9%, which is 85 basis points below prime, all the way up to prime, and now in some cases greater than prime.
Roughly 21% of Canadian mortgage holders have variable rates, and anyone applying for one now or renewing will feel the impact. TD, for example, has hiked its variable and line of credit rates a full point to 5.75%. On a $300,000 mortgage, that's roughly an extra $160 a month. Over 5 years, that's $14,600 extra in interest costs.
The interest rates going up are going to have implications throughout most of the rest of the economy in terms of what people can do in terms of consumer credits, their ability to get lines of credit, getting nervous about what they've got on their credit card. After
shopping around, Bagriaksik did eventually refinance his condo, but it took weeks.
Nowadays, it takes almost like forever.
Many economists believe the U.S. central bank will soon cut its rate, and Canada's will follow suit, making it hard to know if the more expensive borrowing costs are temporary or a new fact of life. Chris Brown, CBC News, Vancouver.